If I were to describe yield, it would be this moving target. It's not necessarily the return that I'm getting. It's not a 3% interest rate, if you will, that you may find on a CD or something else. But it is what I'm getting relative to what the value of the underlying asset is right now, right? So when you think about a bond, understand that bonds do not pay interest. Bonds pay coupons. The coupon doesn't change, right? Let's say it's $500 and the bond's worth $10,000. Then I know my yield is 5%, right? But what happens if the bond is suddenly $11,000? And what would have made the value of the bond go up? You have questions. We have answers. Stick around for Consider This program. We'll break down yields for you in terms of bonds, CDs, and stocks. Well, good morning and welcome back to Consider This program. I'm your host, Joe Clark.
And I'm Daren Hardesty.
And we are talking yield.
Yay.
Oh,
Yay
come on.
Yay for yield, Joe.
These get to be very, very, very exciting. Now, many of you are not watching this. You're actually listening on a podcast or on WIBC or Wilo or Shine 99 or one of the stations that are out there. So you can't see the board in front of me. But I'm going to actually do a little bit of drawing on the board. If you want to be able to see this, you can always go back to our website at yourlifeafterwork.com and be able to pull it off of YouTube or one of those other things to be able to see it. But so Daren, tell me what yield. Now you got to understand, Daren was a math teacher, right? So he understands exactly what he's talking about here. Tell me what yield is.
Yield is the amount of the value divided by the amount that you put in. So there's different ways to measure yield, and it's like you said, it's a moving target. You can measure it based off the original value that you invested. You can measure it off the current value of the investment. But typically you take, if it's for a stock, you take the amount of the growth and you take the amount of maybe dividends that have been paid on that, and then you divide that by the original investment to get the cost yield. You could also divide it by the current value of the investment to get the current yield. So it's a percentage of return. And
Okay.
I know that's probably, that needs correction. So
There's a lot in that. So let's go to the board. And what I want you to, and if you're driving, do not stick both of your arms out at the same time, right? But what you really want to make is a teeter-totter. And let's break these down in terms of bonds first.
Okay.
All right. So typically when you go to buy a bond, you've got a $10,000 investment that you're making. Typically, it can be more, it can be a little bit less, but you got $10,000 that's in the bond. Mm-hmm. The coupon that they're going to pay, notice I didn't say yield, notice I didn't say interest. The coupon, let's just say that is $500. Now, where does that $500 come from, Daren?
it's a great question.
How did I decide to give you $500? What made up that amount?
It's the coupon rate.
But why? Why is it 500, not 600?
I don't know.
There you go, because we're not in the bond pricing business, right?
That's right.
So what happens when you look at this is they're going to look at the current interest rate environment when it's issued, right? The second thing that they're going to look at is the credit quality of the underlying issuer, right?
Okay.
So Apple can borrow money cheaper than the city of Anderson, right? Because Apple's got billions of dollars in the bank and the city of Anderson does not, right?
Sure.
That's credit quality. The lower your credit quality, the higher the coupon needs to be.
Okay.
All right? So the first is the interest rate that you've got that's going on in the marketplace. The second's the credit quality. Then the third, if you will, and duration is the word that we would use, but we're just going to call it the time.
Okay.
Is this a 10-year loan? Is it a 5-year loan? Just think about that. All bonds are nothing more than a loan.
Right.
Somebody is loaning somebody else money, whether it's corporate, municipal, government. You're making that loan. So I've got a $10,000 investment and I've got a $500 coupon that's going to get paid to me. It's typically twice a year, $250 at a time, right? And that's how it starts, right? So let's just put some stuff over here. The interest rate environment, obviously we knew was 5%, hence the $500 for the $10,000 bond. The quality is where you came up with that number, and let's say that it's a 10-year note or a 10-year bond, if you will, right? Do interest rates go up and down, Darren?
Yes, they do.
Yeah. And so when an interest rate goes up, what happens to the value of my existing bonds?
It goes down.
It goes down. So think about that teeter-totter again. If interest rates go up, the value of my bond fell. Now, am I still getting the $500 coupon?
Yes, you are.
Unless they go default, right? Unless they default, I'm still getting $500. But what happened to my yield?
It became less.
The yield became less. Now, if the value of the bond went down, right? And so let's just say that it's now $9,000 instead of $10,000, but I'm still getting the $500 coupon, right? What effectively happened to my yield?
It increased.
It actually goes up, right? So you've really got to think about that teeter-totter. It's some of this is dangerous because you'll hear people, especially when they talk about bond funds, they'll talk about the yield of the bond. So the way the yield goes up is for you to lose money, right? If somebody bought that bond for $9,000, is that at a premium or a discount?
That's a discount.
That's a discount. It's less than what the bond is going to mature at, right?
Right.
And if they paid $11,000 for the bond, they paid a what?
A premium.
They paid a premium, right? All of this stuff matters in this crazy interest rate environment world we're in. You know, one of the things that I know shocks people who are not used to dealing with us, but did the bond world have a good year or a bad year in 2020?
A good year. Well, in terms of returns, it was a good year.
In terms of return. So the best way to think about that, yield really doesn't matter on a bond except when you're going to buy it. Right? I mean, and remember, it's over 60%. It's about 68% of bonds are never resold, right?
Yeah.
So people will talk about their yield in their portfolio for a bond. All I want to care about is a coupon.
Yeah.
Right? I mean, how much income is really, really coming out? So tell me why the bond market had a great year last year.
Interest rates went down.
Interest rates fell. I mean, just like crazy fell. Yeah. And since the election, they've been going back up. So why have bonds had a challenging 2021 so far?
The way I understand it is the bonds that had interest rates that were at a premium last year got sold. So a lot of people got a lot of those returns, and it kind of squeezed the market. And right now, nobody's wanting to buy bonds at that low coupon. So it's not getting, when you have a 1.5% give or take return on a 10-year note, it's just not something a lot of people want to get into.
But they were getting into it last year at 0.61, 0.71.
Right.
Right now at the time of this recording, it's about 1.66, 1.65. Why would people want to be in at 0.61 but not want to be in at 1.66?
Because the value of the bond was increased.
The perceived value,
right,
of not of the bond, but of where the interest rate environment is today. And a big part of that is the stuff that you hear me talk about. We talk about it on the Market Carver. There are many of us who believe inflationary pressure is real, right? Now, I will tell you demographically, we're going to talk about this thirdly. We're going to talk about it in the Market Carver. Demographically, the economy is set up for a lot of deflation. Older people tend to spend less money. COVID certainly was deflationary in terms of pressure because it limited the places that I could go spend money, right? Now, the Federal Reserve tried to overcompensate for that by putting trillions into the system, right?
Yeah.
I mean, the amount of money that they put in, and you go through that basic theory of inflation, too much money chasing too few goods, right? The goods didn't increase, the money did, thus you should have inflation. And so you have this battle back and forth right now over whether inflation is really occurring or not. I tend to think inflation is heavy on service and not so heavy on goods. All right, so the economic numbers you may hear are different, but the ones that people are experiencing from a retirement standpoint, that's a whole nother story. Remember, we are all unique. So I gave you the bond example. What's the difference between that and a stock?
A stock can pay, well, the stock's going to pay interest. If it could pay interest or dividends.
Doesn't pay interest. Pays dividends.
Pays dividends.
Okay. Can pay. Doesn't have to pay.
Right.
Okay.
Just depends on the the stock itself. They're all a little
So
bit
we got this 10. So let's pretend that's the bond that we have on our little drawing board, right? We have our $10,000 stock now.
Yep.
Right. So we paid 10 grand for it, and it's paying a $500 dividend. Right.
Okay.
Again, this time it's tends to be quarterly, not biannually. Right. So we got $125 that's coming out 4 times a year. Right. So we can do some math and realize that that's a 5% yield. Right. You get a $10,000 bond
Yes.
paying $500.
Yeah.
Right? There we go. Right? So do stocks go up and down?
Absolutely.
Okay. So when a stock goes up, by definition, the yield falls unless they increase the dividend. Right?
Right.
So there's different than a bond where a bond pays a fixed coupon until that bond matures, right? Stocks can actually change, the board of directors can actually change the amount of dividends they pay. So when you hear people talk about the S&P 500 trading at 2% yield,
Right.
or a yield of 2%, right? That means when you buy a share of the S&P 500 in terms of SPY in the SPDR, that dividend yield right now is 2%. If the S&P 500 goes up in value, suddenly your yield on paper fell.
Right.
Right? Now, that didn't mean your income changed. That just means your yield.
Right.
So every day we get a vote, and right now with about $620 million as of the time of this recording, right? Adam and Andrew and I get a vote where that $620 million is going, where the best home for it, for your financial vision, the best home for it today. Where's the best place for us to be able to put it? And so we want to pay attention to that yield, right?
Right.
The higher the yield, the more we like the stocks,
Right.
Now, Adam came up with this, I think it was 2007. If you don't buy a good company with a dividend yield of 7%, you're probably making a mistake. And if you buy what you think is a good company with a dividend yield over 10, you are probably making a mistake, right?
Gotcha. Yeah.
I mean, because there were companies that just couldn't keep up the dividends, that just went under, and then there were other companies that had plenty of money, right? It's just the whole stock market got taken down.
Didn't that happen with GE? They had a commitment to pay a dividend, and it got them into trouble.
Just a little bit.
Yeah.
That's a whole long. I'm reading The Hot Seat right now with Jeffrey Immelt, and it's an interesting book, and we have a lot of people that came from the General Electric background. So very, very interesting. 800-928-4001. Go to yourlifeafterwork.com. Learn more about yield and things like that. While you're there, get signed up for the Market Carver. It's a free video that we send out every week where we talk about these kind of things. And Daren, I appreciate you bringing yield into the conversation.
Happy to learn.
Go to yourlifeafterwork.com, 800-928-4001.